We are live.
Perfect. What's going on, guys? It's David Piatek and Lourdes Fernando with VA Housing Education. And guys, we have a treat for you. Today, we're going to be talking about using the VA home loan and purchasing a multi-unit. So there's a lot of cool things that go with the VA home loan, and this is definitely one of them. I'm currently serving in the Army National Guard. I've been in the lending business for about 18 years. Love what I do, and we help clients across the country. Lourdes, if you want to introduce yourself.
Sure. So my name is Lourdes Fernando. I'm in the Chicagoland area, originally from California, and I am a landlord. So I actually used my VA home loan to purchase a multi-unit. So I am living proof that you can do it. And I'm really excited about this class because we are going to talk about all the ins and outs as it goes into purchasing a multi-unit.
Right. And Lourdes, you and I went through that journey, and we help a lot of clients, right? So, and the one thing you guys got to know about like what we talk about today is we're going to use Chicago as the example just because, we're both from there. But this could be applied anywhere in the country as long as they have multi-units. So this is, really going to break down how the program works, how it's going to work within the rental. So we're going to do a deep dive into it. Now, the one thing is that everyone's situation is different. It's unique. So don't disqualify yourself. When we're talking, you might be like, well, that might not be my situation, or hey, I might have some time. It's better if you talk with a professional for them to be able to guide you through that process, right? And that's what we do at VA Housing Education, getting you connected with lenders, realtors. It's a breeze. It's critical to work with the right people, right, Lourdes? You and I, in both, from different sides of the table, I've worked with people where you're like, hey, what am I really getting out of this? So I'm going to just jump right into this. So today's agenda, right, is we're going to talk about what things have changed that have made multi-units really possible in any market. The other thing we're going to talk about is what does your financial snapshot need to look like? We're going to talk through that multi-family journey. And then we're going to also talk about what to look for in a multi-unit property. And then we're also going to go through understanding the complexities of a rental market. So you guys get an idea of like, well, where do they come up with these numbers? And then we're actually going to go through real life examples, right? So properties that are currently listed right now with rent rolls, current interest rates. We're not going to say, oh, interest rates are 3% because they're not, right? And right, Larissa, and that's probably like one of the main questions we get from consumers is that, well, is it the right time to buy? And that's an individual answer, right? But what we're going to show you today with the examples is that it doesn't make a difference what the rate is because you're still going to cash flow. And Lourdes, why did you purchase a multi-unit property?
So I purchased a multi-unit family because I was in a transitional phase in my life to where I wanted to, and I always wanted to be a landlord, but I really wanted to focus on my career and other things and not worry about a mortgage. And I'm an entrepreneur, and the income's not always secure for me. So I just wanted to make sure that at least my mortgage is being paid for. And also I can create generational wealth and not pay that much in taxes. So there was a lot of incentives as to why I became a landlord. It is a lot of work, and I got some gray hairs on my head now, maybe because of my age or maybe because of that. I'm not sure. But but yes, I love I love the decision. I'm very handy now. I've learned how to fix a ton of things, and I have a ton of handyman and women that are in my phone now to fix any repairs needed.
That's awesome. Yeah, and it's not for everyone, but it's surprising how many veterans don't even realize that you can buy a multi-unit. I believe out of the 22 million veterans that are out there, only 12% of them have used their VA home loan. And I think there's only like 40-ish thousand loans done for multi-units, which is mind-blowing. How many people don't realize how their benefits work. And just to kind of give you guys a caveat to this, we do a lot of courses on just understanding the VA home loan. So when you're walking into this, you're kind of walking into like having a baseline and then us building on that. So just kind of be aware of that. So again, you want to take some of our normal classes that we have, because every second Tuesday of the month, we do a consumer class that's just talking about VA home loans that gives you that base. It's at 6 Central, 7 Eastern time. And then every fourth Tuesday, like today, we're doing a specialty class. Like last month, we did a condo class, like how to buy a condo. This time, we're talking about how to purchase a multi-unit property. So let me break down why it's a lot more attractive now to use a VA home loan for a multi-unit property. So in 2019, just to give you guys some background, they passed what's called the Blue Water Navy Vietnam Veterans Act of 2019, which basically lifted the cap on VA home loans if you don't have an outstanding VA home loan. So if you want to buy a $3 million 4-unit property, let's say in Lincoln Park, you can do that. Now, you remember, there's eligibility and qualification. Eligibility is, do you meet the time and service and character of discharge, right? So you did the right amount of service, you got your active duty, honorable, or general. Hey, you served in the National Guard or Reserve, you meet the criteria, and you have an honorable discharge. Well, you meet that criteria. Now, you also have to be able to support it with the income, right? That's important to note on that, because you still have to be able to afford it. That's why there's 2 parts to that. Now, if you have a VA loan and you want to keep it, then it goes back to the old rules. And this isn't a math class. We have to spend like 30 minutes to an hour just going over it. So definitely just check that out on our online free resource video about all of that. The other part that significantly changed the how you could purchase a multi-unit is they allowed you to use rental income if you met 2 criteria. Now, before, and what I mean by that is like using the additional units rental income to actually help you qualify to buy a place, right? That's why when you purchase or get pre-approved for a single family, you can get 3 or 4x that dollar amount with a multi-unit because you're using the additional income to qualify. And I mean, that's, Lourdes, for a lot of our clients, like we've been able to help them purchase like better cash flowing properties because, and it also just expands their price points too.
Yeah, that's a great, I am one of those that
Right.
I was able to utilize the rents, and it is probably one of the most best kept secrets. And, well, I guess it shouldn't be a secret, actually, everybody should know, but that's why we're
Right.
here to share the information. But it's a total game changer, and I'm so happy that you told me that I can do this. So I put a game plan together, which we're going to be talking about establishing a plan later in the PowerPoint or the discussion. But yeah, it is great. You can use the rents, and I was able to use them.
Yeah, no, that's awesome. And that just opens up that possibility for people, because, and we're going to go through the one of the things too, guys, is what we're going to talk about is there's different price points in property. So it doesn't necessarily mean like you're buying a $300,000 property, you're going to make no money, or you're buying a $2 million place and you're going to make a ton of money, right? That's the misconception, is that, oh, this price point won't make me as much as that. But again, it's going to depend on your area, right? So, one part, the VA allows you to be able to use rent rolls. Now, there's 2 stipulations to that. One, if you need to have 6 months of reserves. What does that mean? If your mortgage payment is $1,000 a month, all in, right? Taxes, insurance, you have to have $6,000 in like a reserve account, like cash on hand. Can't be money in the mattress. Please do not do that, because you will not be able to use gift funds for for your reserves. If you have, like, let's say a TSP account, you could technically use 100% of that as reserves now. So, a lot of folks have 401ks, old TSP accounts. People will be like, I didn't even know I had a TSP account and I had like 20 grand in there. Like that's like the hidden money, right? So, or you work towards saving that, because, even when Lourdes and I did it, like Lourdes, when you purchased, it didn't happen overnight. And for most people, it's not overnight. It takes a year or 2 saving and then like getting all that together. So, And then the other thing is hiring a property management company. But just note that it's not necessarily going to be, it's not going to be where they're charging, you have to charge $1,000 a month. The other piece to that is that typically, like, we see between 50 and 70, between 50 and $200 a month management fee. Now, that does count against you for qualification purposes, but still, because you receive rental income, it offsets that. I can get more granular on how the VA looks at income. They look at residual income and after-tax income, but I'll tell you that rental income is actually just deducted to residual income. There's no deductions from it. So it's pretty cool. They use 75% of the rental income. And why is that? Because there's going to be they don't, you don't always rent a property out for the full year. That's why they use that, right? We're hoping, as always, to be able to do that, right? To be able to rent it out as much as possible. There just could be some things that go with that. And I want to touch on something too. When you, for folks out there that already have VA home loans and they want to purchase a multi-unit, it's got to make sense. Because if you have a single family home and you want to buy the home 2 doors down from you, that's like a 3 or 4 unit, that doesn't necessarily make sense unless you sold the single family. It's pretty straightforward. Now, you could make the argument, and you probably couldn't win because the VA has it as it's your God-given right to use the VA home loan. As long as you intend to occupy it, that's literally all you need. But it's very easy to go from a multi-unit to a single family. That's super easy, right? It's just you have to be careful on how much of your VA home loan you use, because then you're going to be somewhat limited. And I also want to confirm one thing, and I did confirm this with the VA the other day. If you have a VA home loan and you refinance out of the VA home loan, but the property's still in your name, then your VA home loan is still locked into that property with the original entitlement amount. I'm sorry, Lourdes.
I want to cry.
I know.
What if you put it into an LLC, David?
Then it's okay. So that's the important thing. So if you refinance your current loan into another loan product, the ownership must be not in your name. So it's the same thing applies if you pay off a VA loan. There's some quirky things, but just kind of keep that in mind. But again, this is why you want to talk with someone that knows what they're doing, and they'll walk you through that process. Another component of the VA loan is the VA funding fee, which is a fee the VA charges, and it's tacked on to the mortgage balance of a property. If you have a rating, or even technically a 0% service connection, you don't have to pay that VA funding fee. But depending on where you live in the country, you can get tax breaks based on either your based on your percentage, right? So I'll give you an example. In Arlington, Virginia, it's 100% permanent in total, right? PNT. And how you check that is on your mobile app, right? You go to your, because some people are like, I'm 100%, but I'm like, are you 100% PNT? And like, what do you mean? You go to your mobile app or you go to your online, go to your benefits letter, and they'll tell you if you are 100% PNT or just 100%. It also changes your benefits, right? But in this case, especially with housing, and for Arlington, they'll go up to $1 million in purchasing and 5 acres or less. In Illinois, what's the breaks for Illinois, Lourdes?
Yeah, so for Illinois, if it's a little different and it depends on your county, but anything over 70%, and if you do not have leases more than 6 months, then it can be prorated. So there's a lot of clients that I have that they have their mother staying with them, they have family members staying with them, so they're not renting it out on a lease, then the whole building qualifies. Now, this is very important. You do have to sign a sworn statement, and it needs to be notarized and sent over to the county. So a lot of clients do say, hey, what if I just say this, or what if I just say that? So it's not going to be prorated, just the unit that you live in and you don't occupy for more than 6 months. You don't have a more than 6 month lease. So it's very important for you to understand that you don't want to get in trouble with the city.
Yeah, and that's the thing. They're going to go back after you. Now you're going to have legal fees, plus you have to pay back taxes. Another important thing to note, right? When you don't pay property taxes, it obviously benefits you from a cash flow perspective, which we didn't factor in on our stuff because When you leave that property and it's not your primary residence anymore, then that property tax waiver goes away. So just keep that in mind. The other thing, if you have the service-connected disability and it's qualifying, then you don't need to use a VA loan in order to get the exemption. You just have to be on the title of the property. So sometimes veterans will have their parents living with them. They might be, 100% permanent and total veterans. They add them to the title of the property, and now all of a sudden they get the exemption for the taxes. So that's just something to keep in mind around that. And the VA loans are also assumable. I have a whole thing on that. So sometimes people's parents will buy a multi-unit and then their kids will assume their mortgage as an investment property and have a VA multi-unit property. So there's a lot of things that you can do with the VA home loan, guys. For most people, when I do presentations, like I can't even understand how that works, right? So we'll be doing future classes on VA assumptions. We'll probably do one here in the next 2 months for everybody on how that works with that. The max number of units you can purchase is 4 technically plus a commercial storefront. Lourdes and I have tried to do these. It's a nightmare, right, Lord? It's hard because the criteria for it is tough, right? And some people are like, well, I want to start my own business. Well, now you're starting to come into like a financial thing that might get messed up with it. So yeah, 4 units. And then 4 units plus a commercial space. Honestly, the most common ones are 4 units. Lourdes, what's your feeling on, like, should you look at a 2-unit, 3 or 4 unit? How does that work with cash flow?
Yeah, definitely. Because the interest rates are really high right now, the monthly payments are also very high. So we are looking primarily for a 3 to 4 unit in order to cash flow or bring pretty much not be able to pay any type of mortgage. So anything that's a 2 unit, you're looking, we just had a client close yesterday on a 2 unit and they're going to pay $200 a mortgage, which is not bad. I mean, I'll take that any day of the week. But in order to cash flow, that we do need the 3 to 4s, and those ones are really hard to find right now. And then also at a good price. And we do have some examples, and most of them are 4 units that are under contract currently right now, and we're going to break those numbers down as far as strategies too, as far as what you could do.
That's awesome. Yeah, thank you for that, Lourdes. And what we're going to talk about next, so that kind of sums up how that's changed the space, right? Now let's talk about the financial snapshot. I'll reiterate that never disqualify yourself from a mortgage, from being a homeowner. That's number one. The other thing is, if you get denied by someone, talk with at least one other person, because Lourdes, she's on the real estate, I'm on the lending side. We've had clients that have been denied, and then we're able to help them. But it's also been where they get maybe denied, but they should have never been pre-approved, right? The pre-approval process is you really need to submit all your documents. Don't get annoyed. You're going to have to most likely submit a blood sample. Don't be surprised. Okay. They're going to send you a kit in the mail. You're going to submit it. It's going to be fine. You're going to get a loan. So if you with the VA home loan, W-2 employment is pretty straightforward. Even if there's job gaps, if you transition from school to work, that's very straightforward to use. Civilian or military to civilian, very straightforward. You can use all that income off the bat for the most part. One cool thing about VA home loans is we just had a closing today on a veteran that only received service-connected disability. That's it. That was the only income they had. They bought a little over $500,000 multi-unit, new construction. It's gorgeous. Only one source, only just VA disability income. So there's ways to do these things, right? We have the ability to qualify you without property taxes because you meet the exemption. I mean, how that can be a huge barrier for a lot of people because those taxes are going to fall off. So no, you can do that. Down payment, typically we see about 2.5%ish, 3% across the country. In, let's see, Chicago, we see about 2.5. Let's say in Arlington, like let's say in Virginia, I see about 3. Maryland, DC, like 3.5. percent is the average closing cost of the purchase price. So if a place is, 100,000, no, 100,000 is a little bit different. Let's say 250 or more, because anything under 250 is the same price. It doesn't really change. There's technically no minimum credit score. Like we go down to 500 credit score, which gives you a lot of flexibility with the VA home loan. So, Lourdes, why don't you talk to us about what goes into looking for a multi-unit property?
Oh, we're ready for that.
Oh yeah, we're ready for that.
Okay, we are ready for the numbers. So the biggest thing that you need to do from day one is establish a plan. So that has to be the number one thing. We have to identify the location that you're looking, how many units you need for your specific goal. Some people are really, really set on a specific location, and we just need to be realistic and say, okay, in these locations, this is how much these multi-units are, and you're looking to pay a little bit of mortgage. If you go over here, you're not paying any mortgage. You're actually getting paid to live there. So location is very, very important, and it ties into how many units you need, and then also what your goal is. Are you trying to cash flow, live for free, or cut down on a mortgage payment? Are you going to have short-term, mid-term, or long-term tenants? So there's 3 different ones, and we're going to go through those strategies in a few minutes. And it's very important for you to know, to check, to do some research on all the local rules and any type of restrictions. So to give an example, when I first moved to the Chicagoland area, I moved to a suburb that didn't allow Airbnb at all. And in Washington, I was Airbnb in a room out of my home. I know it's kind of crazy and dangerous, but I mean, it was, I had 2 dogs, 2 pit bulls, and I was like, they're not going to, come into my room or do anything crazy because we got, we have protectors. But needless to say, in this specific suburb, they did not allow any type of nothing. So make sure that you understand the local rules and the restrictions. And then how do you plan? Do you plan to live in this building for a long period of time? Are you planning to live here for a year? Are you planning to live here for 5 years? What is your plan? Because that's going to tie into how much of the loan that you want to go up to. Like earlier, you mentioned you can go from a multi-unit to a single family home. If you want to be in your single family home and you have to get the multi-unit first because it makes more sense in order for you to get that pre-approval, you can have 2 of these on one entitlement. And we're going to have classes on that to discuss that in further detail. And you only have to wait. Okay, I'll answer the question. Sorry, I saw a question come up and I want to answer it really quickly. But yeah, so how long you plan to live in the building? Now for VA loans, it's typically 1 year. And there are some exceptions, and David's going to go into those in a few. But another thing that is part of your plan, and then selecting the right team. So making sure that a team that you are working with knows the intricacies of multi-unit purchases as far as the reserves. What does the numbers look like? How to properly run these numbers? What are the different type of tenancies you can actually get? So finding the right team that can help you and guide you in this process is very important. Okay, so we're going to go over the market, and can you pull up the slides, please?
Yeah, perfect. Yeah, and then just to answer one of the questions that we received is how long do you have to wait after the purchase of a new home to get a multi-unit? So I think there's 2 parts to that, right? So one, there is no minimum time frame to use the VA home loan again. You could literally close on a property, because this happens on active duty. You close on a property 2 weeks later, hey, like I'm PCSing, I'm going to buy another home. You can do that. Like that's no issues with that with the VA home loan. And when you purchase a multi-unit family, you hear a lot of times like, oh, there's a year requirement. There isn't one. It's just, if you don't like where you're at, you can leave. Now, the issue is lenders will look at it and go, well, it has to make sense. If you bought a multi-unit property and you want to buy another multi-unit property in the same area, then it starts to get a little dicey because there is no restriction on using your VA home loan for an investment vehicle. FHA does have that restriction, but it has to just make sense. Like, hey, I live in a 2-bedroom, 1-bathroom multi-unit. like the floors are. I need a bigger place because of whatever family expansion. I want to go to a different school district. That all is valid, right? Hey, I need a 3-bedroom, 2-bath place instead of like what I currently have. Like that could make sense, right? So all those things are going to have to be within a time frame, and that's something that it's better to talk offline, because that's going to be based on some like your unique situation to that. So yeah, I'm going to pull up the slides right now, Lourdes, so you can take a look at that and go through them. So just what are we going to be looking at over these next couple of slides?
So we are going to look up how to look up your market, different tenancy strategies. So are you looking for midterm, short-term, long-term, and how to actually do this, do the analysis per se. So I learned how to do this just on my own. I'm a very analytical person. I don't sleep. I'm like, okay, I have something in my mind. Okay, this is what I want to do. And then I'm going to figure it out. So I'm just going to share everything that I've learned over the past couple of years, and especially what I used to find my building that I purchased 2 years ago. So I'll get right into it. So one of the first things is we have to look up the market. So we are in the Chicagoland area. So this here is the data, and I did include on the next slide the website to get this information. So here I'm looking, and 52% of Chicago rentals are renting for more than $2,000 a month. So that's huge. That is crazy. That's a big number. And you have a very small percentage that's paying 1% actually between $500 to $700. And most of it is right around that $2,000. Between $1,500 and $2,000 is another 22%. In Chicago, and this is just Chicago, not including the Chicagoland area, but this is just Chicago proper, there are more renters than there are owners. So that's huge when you're looking for investment properties. Where are the renters at? Because you don't want any type of vacancy. You don't want to sit there with your house, on the market for a couple of months. You want to get your tenants in there right away, good quality tenants in there right away. And here, 54% of people are actually renting.
Wow. That's insane. I mean, that just gives it up for an opportunity. And that's why I think Chicago is a great opportunity for people purchasing these multi-units. But it's also the reason why it's a hot market for those, because you're going to see when we go over the numbers, you're going to be like, well, it doesn't make a difference. Even if rates are 7%, it doesn't make a difference. It's still worth it. So
exactly.
Awesome.
Okay.
So this is the what, 1-bedroom. So the average rent, I can't believe that more than 52% of people pay over $2,000 in Chicago. That's another big benefit of these properties. So
right. And Chicago's really big. So if you're not from the Chicagoland area, it's huge. So we do have, and if you go down to rentcafe.com, this is where I pulled the information. You can actually see what neighborhoods, and this is on average on how much a 1-bedroom apartment is going to cost you. So we do have a few that are everything on the left-hand side, all these neighborhoods. I mean, River North, we're at $2,800, Little Italy, $2,700. And this is just for a 1-bedroom. And this is everything included. And then you do have Chatham down at the $800. You do have the Austin area, which says $823, but I just looked at the Austin area and it's closer to $1,400 now. So this is just an average. And all these are quickly going up. There was a study last year that said the Chicagoland area, some areas, specifically different neighborhoods, have seen an increase in rent up to 22%. Now I was trying to find that so we can include that into the slides here, but I wasn't able to find an updated statistics. But last year it was 22% increase in the rents.
Wow. And that's one thing that's nice about buying a place, that you're not worried about those payments necessarily going up. Yes, taxes can change, but your mortgage payment's fixed. And I think one of the reasons why we're seeing those rents go up is because interest rates have gone up. So for people to buy a home, it's still cheaper to rent than to buy if you're buying a single family home. Does that make sense? It'd still be more expensive as far as a mortgage payment would go, minus buying a multi-unit, right? That's where you actually save like that's where you actually make money. So that's a good point on that, Lourdes.
Okay. So I get this question all the time. How do I check the local rents? Now, usually I will run the numbers and stuff like that for my clients, but in case your real estate agent doesn't know how to run those numbers, these are some free local local tools that you can use to look up the rents. What I use is Rent-A-Meter, and this pulls everything from Zillow and from all these different sites, and it gives you a median, it gives you an average, it tells you what the top 75% pays and then what the 25% pays. And then it shows you these little dots within the last, I put within the last month, I put a 1 mile radius, and I wanted to see where and how much these are. So you see all those little red dots, that's closer to $5,000 for a 4-bedroom, 2-bath. So I have a 4-bedroom, 2-bath duplex down. I have 2 of those. And I'm all like, $5,000, maybe, maybe I should rent it now because now's the time to rent. But that is where you can actually see and use that tool. Now, Rent-A-Meter is going to want to charge you after like 5 pulls. So you can always go to Zillow, you can go to RentRage, you could go to all these different sites, but my favorite is Rent-A-Meter, and I'm probably going to pay for that service because I use it so often. But let's see if we go to the next one here. And if you have any questions at any point, you can go ahead and drop it into the web chat, and then we can get those answered for you. And the MLS, this is what real estate agents can pull. This is just a quick report, and I can also see for the regular rents in the area it's also right around the average is 4,100, and I look to see what's sold and also right around that 3,200. And I can click on these to find like properties so that I know, okay, this is what the 4 bedrooms, 2 baths are actually going for, and this is the condition. Because when you're looking at properties, you want to compare apples to apples. So is it a duplex down? Is it a flat? What is the difference and what's the most similar property? Because that's going to be your best comp for rents. And then the next one we have is you also want to check to see if it's going to be good for Section 8 or for any type of governmental assistance and programs. So this here, if you go to wherever you're at, you can I just put the payment standards for 2023 for, I put like Chicago Section 8, and this here will go per zip code, and it'll tell you if it is a 1 bedroom, 2 bedroom, 3, and this gives you the max for that zip code. And this is really important for you to know because sometimes it's better to use governmental programs because they pay more than the market rate. So this is a great tool to utilize. And then very important to know there. I had an attorney call me today and say, do not say that as a landlord, you cannot accept Section 8. There is a landlord and a real estate agent that are, they're getting sued, and they're going to lose because they straight up said, no, we don't take Section 8. So you're not allowed to not consider Section 8. So we can talk offline about that. So this is something that I wasn't aware of. I knew that it's called discrimination. We can't discriminate against certain class because they use that vouchers. So yeah. So be very careful as far as knowing the laws and what you can and can't do. Okay.
That's some of the, and that's important to know because it's like some of the research you have to do when you're going into this, right? So this is why we do these classes, so you can educate yourself on this process.
Right. And that also ties into your strategies as far as if you're looking for long-term, short-term or midterm. Okay. So this is how to check for Airbnb rates right now. And I have personal experience. Airbnb has seen a big change from last year to this year. I'm not really sure what's been going on. It was primarily booked 90%. Actually, last year it was almost 100% Airbnb. And this year there's Vrbo and there's all these different platforms that we're using. My management company manages my Airbnbs, but it's not all Airbnb, and I'm not sure what's going on, and it's not as lucrative as it was the years prior. So this is a good way to check these rates and to run these numbers. You go to the Airbnb site, you add the zip code for which the property is in, and then you select 2 adults, no dates. And then you click on the first comparable property. So if it is a flat, you're going to look for other properties that's a flat. So you can't compare a single family home to, a 3-4 unit. So just make sure it's similar in that. You click on check the availability. And then when you do that, you click on the dates and you do include fees before taxes. And then you take the nightly rate. So this one, for example, it says the nightly rate is $239, and you times that by 15 nights. And the reason you do 15 nights is because it's on the weekend. So that's going to come out to $3,585 for 21. And I looked at, and see, I pulled this in 2021, but in 2021, it's 21 days times 238. That's $5,000 that you can make. And this Airbnb has made $5,000 for that month. And if every single day is booked out, you're looking close to about $7,409 for this one Airbnb. The average rent for a 4-bedroom, 2-bath right now is going for $4,000. So is it really worth the risk to do Airbnbs? So I'm going to definitely look at the numbers at the end of the year. So I'm going to look at them. And if it's not going to be a good option and I can get more money for rent, then I'm going to go ahead and rent or put it as a midterm rental instead of as a short-term rental. So Airbnbs are changing. And if you have personal questions on that, I can give you all the information, because I have 2, and one I fought really hard for with the city to actually be able to have 2, because the city of Chicago only allows 1 Airbnb.
Oh, right. So again, this is the importance of knowing how these things work before you get into them.
Yeah, last year all day long. So what is coming up as far as midterm rentals? It's primarily for professionals like traveling nurses, like what else? Air pilots, and people who are here for work for only a short period of time. Maybe they're on a contract for a year. Midterm rentals are really taking place. So I started the midterm rental probably about a year and a half ago, I want to say, and there was nothing out there. And now, as you can see, the map is full of them. So when I'm also looking, I typed in 4 bedrooms. I didn't see anything with 4 bedrooms. So I had to go 3 bedrooms or more. And all the 3 bedrooms or more are going anywhere between $3,000 and $5,500. So right now, the furnished finders, the midterm rentals is looking a little bit more appealing to me. With this, my vacancy, I only have 2-week vacancy in January, between the 1st of January to about mid-January. And then I don't have a vacancy for the rest of the year. The traveling nurses always go on the same rotation, and there's so many of them. And I turn away probably about 30 applications per rotation. I can only accept 1. Most recently, I accommodated a nurse to, let's see, the slides went away.
Oh, I just took that off.
Oh, okay. You took them off. Okay. So I accommodated the, one of my tenants for an additional, I want to say 15 days. And then I ended up putting another traveling nurse in my unit, because I was like, I'm not moving back for that. So now I moved her to the other unit. Now I'm back in my unit. But I had to do that actually to make up for the deficit that I had in January for my Airbnbs.
Wow.
So yeah.
So what goes into, establishing that plan to purchase a multi-unit?
So what goes, well, you have to do that analysis. You have to run all 3 of those numbers. You have to see if this location permits an Airbnb, because some areas there's not any Airbnbs, and there's a reason why it's not. You have to make sure that you go on the Airbnb website and say, okay, I see a ton of them here, so this is going to be a a good plan for Airbnbs. I'm going to have another one for traveling nurses. I'm going to live in the other one, and I'm going to rent the other one out for a long-term tenant, just so I can be on the safe side. So you really have to establish that plan up front and see, okay, which one's going to be the best method to move forward. Then you can also ask your real estate agent. They should have a plethora of knowledge and say, okay, this would be the best strategy for this property. So when I go with my clients, I'm like, okay, this would be great for, it's next to the train station, it's next to this, or it's next to a hospital. This is going to be furnished finders all day long. If the Airbnbs is going to be too much of a hassle, that's like an everyday thing. I was out doing some yard work, and she's like, I need some toilet paper. Who do I talk to get some toilet paper? I'm like, oh my God, I'll bring you some toilet paper. Like, but I was like, she thought I was out there, and I don't ever do yard work. And I just happened to do it on Sunday. But yeah, I was like, now I gotta, bring some toilet paper down. Oh my God. But it's okay. It's fine.
That's so
But usually
funny.
my management company will handle all of that. So I don't have to do that. But yeah, it's just all about the strategy that you want. Having Airbnbs, it's a lot of work. The midterm rentals, I'm probably spending maybe around every turnaround, I spend maybe about 2 hours, if that, to find a good solid person that actually fits with the days, so I don't have too many day vacancies. I need at least a 2-3 day vacancy to clean it. And then now I'm gonna start charging a cleaning fee, which I don't charge, but everybody else does. So I'm gonna start charging a cleaning fee, so I don't have to do it no more. I waste my 3 hours of cleaning because I like to deep clean. And yeah, so it's just establishing that plan and really knowing the numbers, what you're going to do with it, and also how long you're going to stay in this property. So those are our things. But I know we're going to go into live
Oh
examples.
yeah.
I'm actually going to show you the MLS. I'm going to pull up a sheet and explain what that looks like. And this gets me really excited. It does take some time to run these numbers. So sometimes my client will send me something and I'll be like, okay, I got to really look into it. So hopefully one day there'll be a system, and probably I'll create it or something, but where we can just run these numbers very quickly, the way that I go through each. So one of the first properties, as soon as I saw this in this location, unfortunately we didn't win this offer, but I was so bummed because the numbers were so good on it. So this one had a list price of $365, and then the strategy for this area right now would be a long-term tenants, because market rents for that area for long-term tenants are 3-bedroom, 1 bath are going for $1,800, 3-bedroom, 2 baths are going for $2,000, and 2-bedroom, 1 bath are going for $1,500.
Wow.
And then also, if you do any type of that, like value add to it, it would increase the valuation to $489. So this one was a really good property. And then David, can you go ahead and take us through the numbers with this one?
Yeah. Yeah. So I'm going to run through how the numbers look like, right? So I mean, 6.5 interest rates. So again, this is more for educational purposes only. So you purchase, if you don't have a service connection, you have to pay a VA funding fee, right? That's the only fee that gets rolled into the mortgage. So in this example, $365 purchase, $83.95 funding fee. The VA loan is going to be based on the $373.395. Once you factor in taxes and estimated insurance, you're looking at about $3,033 as the mortgage payment, right? That's the nut every month. Now you look at the rent rolls, you're actually cash flowing $2,200 a month.
So let's take a timeout.
Yeah, right. Timeout.
That's
right?
huge.
Timeout. You $2,200 a month. You still haven't even rented your own unit out. And if someone were to tell me interest rates are 8%, this would still 10%, this would still make sense, right? When you look at a single family home, you look at it with a different lens. With a multifamily, you're looking at it from a investment standpoint. This at 10% interest rates would still be a phenomenal investment purchase. And like you said, Lourdes, a lot of people don't know sometimes what they have, and doing either some repairs, and once these once this neighborhood catches up to these rent rolls, this is indicative of a much higher price point property. So you're going to build equity even faster. And that's what people, and then that's how you find those hidden gems to be like, oh, rents are higher in this area, price points are decent, I can cash flow well. Because in theory, you can sell this home to a true investor for a significant amount more money because of the rent roll. But again, that's you like trying to get that. And then the reserves, right? So this is the amount of money that we talked about, right? You need a 401k, checking account, savings account, money market amount, stocks. It would be $18,397.
So the reserves are just only if you don't qualify for that property. So if you need to use the rents.
Yeah, that's only if you need the rent. If you qualify for the mortgage payment, you don't need any of that, right? This is just saying like, this comes in really handy, especially at the higher price points where you're like, well, it'd be nice. So yeah, just kind of think about that. So let's go
if
to
you
the
want to
next
buy
one.
$1 million property or something. I don't know.
Yeah.
Yeah. So okay, perfect. So this one here too. This one is a 3-unit, and it had a 3-unit with a bit of an additional room in the back, and then potential to duplex down. And this area is hot, like super hot. The ARVs are 920 for 3 units if you fix them up. So when I say ARV, it's the after repair value. So this is if you gut the property, you make it look like the other ones that are generating a lot of rent. So that's what the ARV stands for. You have this one here would be perfect because it's near transportation, it's near a lot of hospitals. So this won't be perfect for midterm rentals. All the 2-bedroom, 1 bath for midterm rentals are renting for $2,300. Market rent is about $2,000, and an Airbnb is $3,500.
Wow.
So what I would personally do for this property is have 1 Airbnb. I would have one midterm, and then I would live in the other one because it has to be owner occupied. So this one would have a great way to make some additional money. And with the ARV being at 920, you put some work in. I think this one needed close to make it to that 920. I think it was close to about $80,000 to $100,000 worth of work that needed to be done to shoot the equity up potential to 920. So you can always, and I'm gonna figure out how to do it because I haven't figured it out yet, but very soon. You can pull that equity out and go buy some more multi-units, which is crazy, or buy a single family home, or do whatever you want to do with that money. Maybe put it back into the property to, maybe add a coach house in the back so you can stay in the back and you have your units in the front. So whatever you want to do with that equity, or do a cash out refi, you can do. What I'm going to do with my equity is I'm going to buy some more properties. So that's what I'm going to be doing. You can do whatever you want with yours. So we can go to... Yeah, so go ahead and David and break this one down for us.
All right, so 600,000 price point, VA funding fee. We got a balance of 613. Total all-in payment is $5,000. And for some people, they might be looking at $5,000 and be like, that's too high for me, or it might be outside your comfort zone, right? But the rent roll is $5,800, so you're still cash flowing positive $832 a month. But this property does obviously require higher reserves because the payment is higher. So it's $29,808 for that. So again, it's phenomenal. Now, is it always guaranteed you're going to get the rent? No, but there's going to be some months where you do much better than you anticipated, and then it's all going to equalize at the end.
And just going back to the other one, the equity potential on this one and the rent increases. This area specifically saw a 300% increase in property valuation within the last year. So this one is definitely an equity stakehold. Like, it's perfect. It's going to go up like crazy. So, all right. So this one I found, this is a closed transaction within this one closed a couple months ago. And this one closed for $236,000. So this one here, market rents are right around $1,200 for a 2-bedroom, 1 bath. And the subsidized housing, meaning Section 8, is $1,287. So
Wow.
this is where I was saying that if you do subsidized housing, you can probably get a little bit more than your market rent. So this is why it's important to look at those options as far as subsidized housing, market rents, and what everything entails, because it might just be a better option. And then you can get a 4 unit for 236,000. Now, this one did come with 2 additional lots. So that's
Oh,
huge because if
wow.
you wanted to buy and not buy, but to build 2 other properties, when that area starts to get up there, then it's going to be a gold mine. So this one was a nice little hidden gem. And I put ARV as a question mark because I haven't toured this property, so I don't know what the inside looks like, and I don't know how much work needs to be done to this property to make it to where it needs to be.
That's
The taxes
awesome.
are low on this. And this one at the bottom, it says no FHA, no VA. So that means repairs might be needed. And then they do have month-to-month leases, 2 vacant units. The basement is available for viewing. And then it says occupy units will be available to you to be viewed. So you're actually going in and not looking at all the units, and that can be the case. And sometimes it could be a little scary, but after we inspect the property, then you can make a determination if you want to move forward or not. Unfortunately, that's just the market out here. Sometimes we do have to view or go in and get an acceptance after the fact. So this was only on the market for 35 days. So that just means that there was nothing terribly wrong. Now, David, when I see V8, no VA, what does that typically mean?
Do we have 3 hours to go over it?
Okay,
All right.
I'll do
So
the short,
I'll give
very,
you the
very, no,
shorthand.
but
So
shorthand.
yeah, so this is something that we do definitely see often where they're like no FHA, no VA. And that's because the property can it be a different, right? Like you said, like it could be at different stages of condition, let's say, because sometimes they might have really minimal things that the VA might come back and say, yes, they have to be repaired. But the nice thing is that you can actually move those items to a post possession, meaning you can purchase the home and then do the repairs later yourself, right? That just requires setting up an escrow account. And there's always the option also of doing renovation loans, which we work with other partners that can do those, right? And then you could do a renovation loan to complete the project. So, and if you don't know, you can also do 100% construction loan with land acquisition and just build your own multi-unit if you would like with the VA home loan.
Ta-da. Awesome. So when as an agent, when I see that, I just call the phone. I just call the agent on the phone and say, hey, what needs to be done? And if my client has enough money to fix those, and that can be taken as is, and we'll do that after the fact, if we can actually utilize the VA home loan. Now, what happens if it has city violations and it's clouding the title?
Say it one more time.
Yeah, if we have city violations and it's clouding the title, as far as you meaning there's a city violation that's gone to court, and when they pull title, it's coming out. So the lender doesn't.
That causes a red flag, right? Anything with title on that's going to basically that's going to stop a transaction.
Okay, so very important. And the reason I asked is because I ran into this issue where I had city violations, and I look on the city website and I do see that it went to circuit court. So I know that it's actually going to be on title. Anytime you see circuit court, they put a lien on the title, and the seller has to fix that, and it's pretty much cash, a cash deal or hard money, because they won't do that. So thank you for answering that. I knew the answer, but I wanted you to tell.
No, yeah. No, it's like, well,
So
it's because it's these small things that if you don't do a lot of V loans or you don't work with a lot of veterans and help them buy properties, it would just be these small things where you're like, oh, I didn't even ask. And now you're 3 weeks into a transaction and the deal falls apart. Like that's horrible. And, we've been in those positions because other people have come to us for help from doing videos like this. And then we're like, yeah, you should have never done this from the beginning. Or, hey, here's a solution to fix it. So again, that's how you check out vahousingeducation.com. We do presentations all the time. And if you need resources, like lending and real estate. That's what we do. And it's across the country. So always happy to help with that. So, all right, Lourdes, you want me to break down these numbers?
Let's break it down, please.
All right. So purchase price 236, which I want to note one thing. Originally list 280, 250, and then sold price 236. So there's definitely some deals out there. No, the market is not falling apart. That's not happening. Okay. It's just in this specific property. So the mortgage payment on this is 1807, which is it's a pretty good number. But now let's look at the cash flow, right? 1,200 per unit, owner's unit, 3,600 rent roll. You're making 1,793 on the property. Now, if you can qualify on yourself, you don't need the reserves then. Remember, that's an important thing you said, Lourdes. If you don't have the reserves, if you don't need reserves if you don't have the payment. So it just makes life a lot easier when it comes to these types of transactions, you can say. So it's
now,
yeah.
Sorry. Now the 1,200 is you need to do some work to this property. This property obviously needed some work, so it does have to be 1,200 ready to go. So you're going to have to put some money into this one. So one thing that when you're looking at the properties, you also have to look at the deferred maintenance, what needs to be done in the next couple of years, what needs to be done right away, because you have to factor those numbers into your cash flow. Yeah, you're going to make 1,795, but what and how many repairs do you have to do up front to get it that way? Because you don't want to have something that is maybe $50,000, $60,000, $70,000, and you're saying, okay, it's going to take me X amount of years to make that on the back end. If the property doesn't have that equity potential, then, for example, so in this specific area, if the ARV isn't justified what the repairs are going to be, then you're going to be in the red. So that's not going to make sense. So you also have to look at it from that perspective, is what type of repairs to make it look like that. And then we do have a question.
For the tax exemption. Yeah, Diane. It's someone just asking, can you have the tax exemption on multiple properties? You only have the tax exemption on one, just so you know. It's always going to be based on your primary residence for that. So let me show you guys kind of what a rent versus buying piece looks like. And then we're going to wrap things up because we've been on air for a little bit, close to an hour now. So one of the things when we talk about paying rent and the mortgage, right? Just take a look at some of these numbers here where if you're paying rent for $2,000 a month over 5 years, that's $120,000 that you've given somebody else, right? And especially if you need a bigger place, the rent is even higher. So even at $3,000 a month over 10 years, $360,000. When you pay rent, you're paying someone else's mortgage. Now, once that they've paid it down enough and they don't owe anything on there, they're just that it's just that equity piece. And then now they have built equity and now they're receiving monthly income, which a lot of people use this as a retirement vehicle. And right now, folks that bought homes 15, 20 years ago, they're cashing out big time on that. It's kind of insane, right? That's why we're also going to have one of the largest transfers of wealth in the history because of how much equity homes have right now. So even with prices decline a little bit, they went up so fast, it still would be above market, even if things were to slow down a little bit. And the thing is, we're not tax experts. Talk with the CPA if you want to learn about those tax advantages. Sometimes, we'll have a CPA with us on these calls to kind of explain some of this stuff. But the issue with that is that everyone's situation is so unique that you really, it's going to be based on what you qualify for that. So we'll stay on just for like another couple minutes. If you guys have any questions, please drop them. We've had some good questions from our Zoom. We're also streaming live, right, through Facebook, LinkedIn, and YouTube. So, happy to answer any questions you guys might have, or just connect with us at vahousingeducation.com. Go to the partners page, and then you're able to connect with us, setting up a call or a meeting. And then if you log in, you can see all the courses that we have. It's all free. And then remember, every second Tuesday of the month, we do a regular VA home loan class at 6 Central, 7 Eastern. It's the same one every month, just talking about how benefits work. And then every second Thursday of the month, we do a specialty class like today, multi-units. Last one we did was with VA condos. And then let me look up the next one that's coming up.
While you're doing that, David, I know like David said, we're not tax specialists or advisors, so definitely consult with a CPA. But there are some huge benefits as far as tax incentives when it comes to owning a multi-unit, to include depreciation, accelerate depreciation. You can write off your insurance, property taxes, mortgage interest, attorney fees, management fees, utilities, advertising, marketing costs. If you have a Airbnb or a midterm rental, and if you don't have that, or I'm sorry, and you can also, sorry, that's for if you have a rental period, and then you can also write off management fees, cleaning fees, wear and tear, and utilities, gas, water, etc. if you have short-term to midterm rentals. So you definitely have so many, and definitely consult with the CPA so they can tell you exactly what you can write off, because there's a ton of benefits as far as taxes. So that's a whole different story, and we're not in that profession. So yeah, you can ask us offline.
Yeah, so cool. Well, thank you for that, Lourdes. Yeah, if you guys have anything, any other questions, like I said, please, feel free to reach out to us. I think that's the easiest way. And then we're happy to answer any questions. So hope you guys have a great evening. We'll stay on for another minute or so.
All right. I think that is
Perfect. All right. Thanks,
that is
guys.
it.
We'll talk.